Berkshire Hathaway reports a massive 24.7% drop in net income for 2025. This titan has halted share buybacks, even as its cash hoard swells to an unprecedented $373.3 billion. Strategic pause or warning sign of an empire in transition? Today we'll use rigorous fundamental analysis to peer beyond headlines and uncover what's truly happening at Berkshire. When you first see Berkshire's reported 24.7% decline in net earnings, dropping to $66.97 billion, alarm bells might ring. Headlines scream profit collapse. But for the astute investor, this dramatic fall is largely an accounting artifact. The twist: this figure reflects non-cash, unrealized investment gains and impairment losses, masking Berkshire's robust operational vigor. Never mistake GAAP accounting fluctuations for underlying business performance. GAAP, or Generally Accepted Accounting Principles, reports non-cash paper gains or losses, swinging net income without impacting actual cash. True value investing demands peering beyond headlines, avoiding emotional pitfalls. This leads us to a more revealing metric: free cash flow. FCF is the actual cash a business generates after operating costs and capital investments. Despite the net income drop, Berkshire's operating cash flow surged an impressive 50.3% to $45.97 billion, driving a substantial 115% improvement in FCF to $25.4 billion. While income statements might look gloomy, this robust FCF generation confirms Berkshire's diverse businesses are immensely profitable at their core. Real capital generation often hides in plain sight. For investors, FCF is the truer measure of a conglomerate's underlying health and a solid investing strategy. Yet this cash flow surge introduces a profound enigma: the cash conundrum. Berkshire's liquidity position is astounding, with cash, equivalents and US Treasury bills soaring to $373.3 billion. The market celebrates this war chest as unparalleled stability. Here's the paradox creating investor frustration. Management halted all share repurchases in 2025. This decision, given the cash pile, signals either a lack of compelling investment opportunities in an overvalued market or a belief its own stock is fully valued. Excess cash, while a fortress, becomes a drag if not deployed productively. Its deployment is a critical unknown under new leadership, impacting future investing strategy. Now let's investigate why some previously deployed capital has been problematic. Berkshire recognized staggering $10.68 billion in pre-tax impairment losses on its equity method holdings, like Kraft, Heinz and Occidental Petroleum. Equity method holdings mean Berkshire owns a significant but not controlling stake in these companies. At first glance, this looks like strategic investment failure. The twist: these are often non-cash write-downs, signaling a fundamental reassessment of value or past overvaluation. Disciplined due diligence and a long-term value investing lens are paramount. Even the best investors face recalibrations, raising questions about future investment selection. Moving from past stumbles to current operational challenges, let's turn to the GECO gamble. GECO's underwriting expense ratio deteriorated significantly from 9.7% to 12.4%. This ratio, showing GECO's cost to acquire and service policies, worsened due to aggressive advertising and rising claims. The reality is nuanced. More spending doesn't always mean profitable growth. GECO is paying more for customers who are also more expensive to insure. Growth at all costs, especially in competitive markets, can erode profitability. It's a delicate balance impacting long-term profitability, demanding careful stock market analysis. Not all operational segments face headwinds. The BNSF bright spot shines through. Amidst mixed performance, the BNSF railroad segment demonstrated remarkable resilience, with net earnings rising 8.8% to $5.48 billion despite flat revenue. Flat revenue often signals concern. But the powerful twist: BNSF achieved this through excellent operational efficiencies, improved labor productivity, and strong cost control. This proves strategic infrastructure investments and effective management drive superior results even in challenging markets. Operational leverage and sustained competitive advantage are powerful drivers, revealing deep fundamental analysis at work. But before comfort, we must address the wildfire shadow. Corp, a Berkshire Hathaway energy subsidiary, faces catastrophic litigation from past wildfires. Plaintiffs seek upwards of $50 billion in damages against accrued provisions of just $2.85 billion. This unquantifiable tail risk is an existential threat. These events have a low probability but catastrophic outcomes. While the market might downplay long-shot legal battles, potential adverse rulings on treble damages represent unprecedented liability. Comprehensive fundamental analysis requires probing contingent liabilities, not just current assets, to avoid hidden dangers and ensure a sound investing strategy. Thankfully, Berkshire's balance sheet provides a formidable counter-argument. A conservative fortress. Total shareholders' equity rose to $719.70 billion. The debt-to-equity ratio remains exceptionally conservative at 17.9%. This means Berkshire funds itself largely through its own assets, not borrowed money. It underscores an unwavering commitment to financial prudence, providing a robust buffer against global uncertainty. This strategic conservatism reinforces its reputation as an impregnable fortress, underpinning its value investing approach. All these dynamics converge on the succession question. The official transition of capital allocation from Warren Buffett to Gregory Abel on January 1st, 2026, introduces unquantifiable strategic risk. While Buffett remains chairman, the deployment of that massive $373.3 billion cash hoard and future merger and acquisition strategy now rests with Abel. His long-term vision and execution are yet to be fully tested. This tests Berkshire's decentralized model and raises a perennial question for value investing. How much of a company's success is tied to one visionary leader? Recent news, including the acquisition of Occidental Petroleum's chemical business for $9.5 billion on January 6, 2026, Pacificorp's $575 million settlement on February 20, 2026, an agreement to sell Washington operations for $1.9 billion, offers early glimpses into Abel's strategic maneuvering. So, does Berkshire Hathaway's reported 24.7% profit drop signify a strategic pause or a warning? It's both, but not as headlines suggest. The net income decline is largely an accounting illusion, masking robust operational cash generation and an impregnable balance sheet. In truth, Berkshire is strategically pausing, accumulating a colossal $373.3 billion war chest under new leadership, ready for opportunistic deployment amid operational challenges and that existential wildfire risk. Berkshire stands at an inflection point, transitioning from a singular visionary to a disciplined, distributed command. Its core strength is undeniable, but future capital allocation under Gregory Abel will define its next chapter. I believe within 36 months, Berkshire will execute significant, unconventional capital deployments, fundamentally altering its portfolio, demonstrating a new era of strategic value creation, even if it means sacrificing short-term buybacks for long-term accretive growth. But I want to hear your take. Given Abel's early moves and that massive cash pile, what unconventional capital deployments do you foresee for Berkshire Hathaway in the next 36 months? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.